Okay, thanks everybody. Thanks so much for coming to the conference and Saturday morning coming to my presentation. And I know that you guys are here. You're going to hear a lot of information. It's hard to retain it all, so I want to keep things as simple as possible. If there's only one thing to take away from my presentation, it's that at least over the next couple months, I think stock markets around the world are going to rally and gold is going to take a breather. And I'll get into that and tell you why. But that's probably the biggest takeaway, at least for the short term. Okay, so, well, you have that one thing to remember, but I'm going to cover three things, and I'm also going to cover the context of where precious metals are currently, and then their potential trajectory over the next 12 to 24 months, assuming the Fed continues to cut rates. That's a huge fundamental key. Okay, so I'm going to get into why I think the stock market is going to rally and also stock markets around the world and why gold is going to correct. Focusing on the stock market, so we all know about the inverted yield curve. It's already happened, and it's typically a bearish omen for the economy and the stock market. However, there is a lag, and depending on the data that you look at, because I was researching this and people pick different points of when the inversion exactly happened. So if you look at the data, it's scattered a little bit, but I like this here, and you can see that on average, after the 2-year and the 10-year Treasury yields invert, on average, the S&P rallies 13% after that point. And you can see the average. The average or the median, it tends to be around 10 to 11 months. So potentially 10 to 11 months from now, the stock market could be higher, but that could be the point where it peaks and rolls over. So now is not the time to get bearish on the stock market. Now is actually the time to get bullish. So again, over the next probably 6 to 12 months, I think we're going to see higher stock prices. But I don't think we're going to see the cycle extend beyond that. And this is a chart looking at the S&P 500 along with sentiment. And if you look at those points, this is looking at the AAIA investor survey, which is a well-known, a well-followed sentiment indicator. And this data is looking at the spread between bulls and bears. So if that red line is high, that means there's too many bulls. If it's too low, that means there's too many bears. And where we are right now, we can see this is the second lowest level basically since the GFC. So, and the stock market is, it's been consolidating, but it's kind of grinding higher. So it's been in a base with a bullish bias, but look at how well it's done given how everybody's panicked. So again, this is the second lowest in the last 10 years. So a lot of money has come out of equities and it's gone into bonds and into gold to a lesser degree. But I think we're going to see more people go into stocks now, and the market's going to go higher. And this is another sentiment survey, and so this is looking at basically fund manager positions. I think Bank of America Merrill Lynch, they put this out every month. It's a great survey, great sentiment indicator. So we can see that managers, and this shows the percent of managers that are underweight equities, so a net 20%. And this is the lowest in the last 10 years since the GFC. So in recent months and quarters, managers have been getting out of stocks. So, it's already been bad news in the stock market, has already been fully discounted. There's very few people left to sell. Here's another one. This is just fund flows, and it's flows into equity funds minus flows into bond funds using a 6-month average. And or a rolling 6-month time frame. And again, this is the lowest since 2005. And based on that info, we can see over the next 6 months, like when that happens, you have an average return of 10%. Over the next 12 months, an average return of 17%. So, I mean, all this data is arguing that stock markets they're going to rally. That looks like it's going to be the place to be, at least over the next couple months. So with that said, let me talk about the current context for precious metals. And so this will be something very important to watch. Here we have gold divided by the S&P 500. This is the Fed funds rate. This is the yield curve, the 10s and 2s. And so what's typically bullish for precious metals is when you see a steepening in the curve, and usually that's caused by the Fed aggressively cutting rates. So they haven't quite aggressively cut rates yet. In the 70s, you would see a steepening yield curve because inflation was really taking off. I think we'll see that at some point in the future, but not in the next year or so. So the way the curve is going to steepen is the Fed is going to have to eventually aggressively cut rates down to zero again. But it hasn't quite steepened yet. And when we get that steepening, that's when we should see precious metals really outperform the stock market. So this here, gold against the S&P 500, this ratio, it got up to this resistance over the last couple years. I think it's peaked for the time being. It's going to come back for at least a couple months. But this is really the last thing that we need to see for gold to, at least for me to think confidently that it's going to go back to 1900 and higher, is gold outperforming the stock market, like strongly outperforming. So it hasn't quite happened yet. So again, when will that happen? When the Fed aggressively cuts rates and the yield curve steepens, that's when we'll probably see that. And here in 1998, this is when we had a false signal. We can see what happened. You know, they only cut rates once or twice, and we just had this little blip. I don't think that's going to happen this time, but I mean, you never know. It's just something to keep in mind. And here we have the gold chart, and this is gold against foreign currencies. If you follow my work, I really love tracking gold against foreign currencies. So we're looking at the dollar basket, gold against the dollar basket, which is mostly the euro, but I mean the yen is in there, the pound, et cetera. Another way to look at gold against foreign currencies is just gold multiplied by the US dollar index. And so gold against foreign currencies, this tends to be a leading indicator for gold. We go back to the last bull market, and gold against foreign currencies, in the middle of 2005, it had a big breakout. And then gold, of course, followed a couple months later. And then after the GFC, after October 2008, I mean, this hit a new all-time high at the very beginning of 2009. And that didn't happen in gold itself until I think October 2009. So that was a lag of maybe 8 or 9 months. Now, again, this is at a new all-time high. It begs the question, okay, when's gold going to go to a new all-time high? I don't know, but you know, maybe in a year or two. But this is a positive divergence. It's very bullish. And again, to go back to the last slide, so we know that gold against foreign currencies it's made a new all-time high. So basically, gold against every major currency is at a new all-time high, except for the yen. The yen's really close, except for the currencies that are tied to the dollar, like the yuan and the Swiss franc. So other than those, on this move, gold basically it's trading at a new all-time high against foreign currencies. So that's great relative strength from gold. But this is the one thing that's missing, is gold outperforming the stock market. If, you know, whenever that happens, we have gold outperforming the stock market alongside of gold performing really well against global currencies, that's when you get gold going to $2,000 an ounce. Okay, so let's talk about the mining stocks and where we are here and now. And so these are very big multi-year bottoming bases, and it's going to take a little while to break out, but if we see where GDX is right now, it's basically rallied up to this multi-year resistance. It's got up really close to the 16 high, you know, this resistance over here. So if and when GDX breaks above this, there's a potential upside target there of almost 50. And same thing with GDXJ, although it hasn't gotten up to 50, it's here at 42, and it's made a little double top here. So over the next couple months at least, we're probably going to see correction, consolidation. And I mean, this is a long-term super bullish base, I mean, this is something that could take 3, 6, 9 months to correct and consolidate before it really has the energy to break through and make this massive move higher. So again, this massive move, I mean, it's looming, but it's not imminent. Over the next, at least the next couple months, we're going to correct and consolidate. That could continue well into 2020, and it's obviously going to depend on quite a bit on rate cuts. I mean, the rate cut, whether they do a quarter point or a half point in September, I mean, that's already baked in. So it's going to be looking past that. Are we going to see more and more rate cuts? Are they going to cut to 1% and down to 0 before the election? If they do that, we're probably going to see, massive moves higher in all precious metals. So that's the fundamental catalyst. But here and now, from now until the end of the year, I think we've probably hit the peak, and we're probably going to correct and consolidate. So, stock picking, following individual companies and their catalysts, that'll be very important, at least over the next 3, possibly 6 months. Okay, so next we have silver, and this is the monthly candle chart of silver. And I absolutely love this chart. I love the big double bottom we have here, and even this huge double bottom, even the right side of the bottom is a double bottom itself. However, now it's a little dangerous to look at monthly charts this early in the month, but this level around mid-18s, call it 1850, I've been talking about this for a while. So we had a strong move above it, but in the last couple days, we came back below. So I think this resistance is probably going to hold, and silver is going to correct a little bit. So that's where silver is. But the key for silver and a huge move is getting above 21. Like, this is the monthly chart, but looking at a quarterly chart, whenever silver makes a quarterly close above 21, that's when you're going to see a quick move, probably to 24, 25. Okay, so let's talk about the long-term trajectory. And I'm not, sometimes when I talk about long-term, I can mean 5 or 10 years, but really just over the next year or two, what's the potential trajectory for precious metals beyond this potential correction that I'm talking about? So let's go back a little bit, and this is something that I've been talking about for a long time, how rate cuts are really the catalyst. This is the slide that I had in May when I gave the presentation then. Now this turned out to be dead on here, basically, because when's the bottom? The rate cut was in July, so we basically had a low in May. But at that point, when I gave the presentation, we didn't see that massive shift in the Fed. I was thinking maybe they cut in December, and so it's going to take some time. But you look at the data and rate cuts and the start of rate cut cycles. Those are, that's the fundamental key for precious metals, and at least gold stocks, especially with this data. And so it begs the question, well, are they done cutting rates? How much more are they going to cut? Nobody knows the answer. If you look at the market is expecting probably 3 more cuts. But again, if the Fed is going to cut rates down to 1% or even towards 0% in the next 18 months or the next 12 months, and we see those types of aggressive rate cuts, then we're going to see probably around election time, gold close to 1900. So rate cuts are the huge fundamental key right now. And I don't have the charts for this, but this is a very interesting pattern that the gold stocks have followed. And so what we're looking at here are what I define as a mega bear market is something that's gone down for close to 3 years in over 80%. And what's interesting is all of these markets, they followed a similar pattern where, when they hit the absolute price bottom, they have this really strong rebound for 6 to 9 or 12 months. And then after that, they tend to have another correction that's longer in time than the rebound. So all of these, they had this, they gave something back, something of the rebound. But look at how long the correction lasted. Roughly on average, we can say 2 years or minimum of 1.5 years. And so the time between the first low and that second low after the first big correction, these are all very similar. And so we can see where gold stocks bottomed about 11, 12, 13 months ago. And so they followed this pattern really well. And looking at this data and looking at gold stocks, I mean, the next leg up and how long it lasted here, a year and 6 months, 2 years, et cetera. So at this point, GDX is up about, I think about 60% or so from its low last year. The high point a week or so ago was 75%. GDXJ is up, I think, about 55 or 60% right now. So there's still a lot of upside when we compare to history. And again, the fundamental aspect to go with this is more and more rate cuts. If we get more and more rate cuts, then we're going to see gold stocks, break those multi-year resistance levels and, make another huge move to the upside. And so I'm going to end with some analog charts because I love comparing where we are currently to history. And this is comparing the bear market from the late 90s to the bear market since I chose 2012, the secondary peak. But if we're looking at, in the very, very big picture from a bird's eye view, the best comparison to where we are is probably the earlier mid-1960s. But with respect to just looking at gold, historically, this is the best comparison. So you can see where we are here and now. There's a good similarity here, but we're only comparing it to one point in the past. So, it's not to be taken that seriously, but I mean, we are kind of following along, and this could get us close to 1800, 1900, sometime next year. And in this chart, I'm looking at, this uses weekly data, and I'm looking at all of the rebounds in silver after some mega multi-year bear markets. So there's 3 of those, plus I added in after the 2008 crash, because that was such a sharp crash. And you can see where, these historical rallies have gone and where we are here and now in black. Basically, if you take the average of these 3 or 4, that would put silver at about $24 an ounce at the end of March next year. So that's about 7 or 8 months from where we are now, $24. Now, this in black, this is a junior gold index that I've constructed. I've changed it a couple times, but this is actually fairly strong. So I've put some very strong stocks in this index, like Kirkland Lake, Wesdome, West Haven is in it. I didn't pick only strong stocks, but half of it is probably pretty strong leader type stocks in junior land. And just comparing it to in blue, this is basically from the 2001 low to 2007 peaks. And this is if I switched into a basket of silver stocks. And that ended up from 01 up to here going up 110 times. This is about 35x here. And where we are here and now, I think we're just below 4x. So this is, to replicate this index is very hard. But you can see, if you own a basket of the strongest stocks, this shows the potential if we continue for a couple more years. So another fun analog chart just to see where we are since that 2016 bottom and how it compares to the 2008, which is in red, the 2008 low and the 2001 low. And I think this is my last chart, and this goes back to what I talked about in my updated book, which is if we're looking for the best historical comparison on a real bird's eye view type basis, the 1957 low in the gold stocks is very similar to the 2016 low. And so that's why I think we're kind of in the early to mid 1960s potentially. There's numerous similarities. If you want more info on that, you can go to my website at thedailygold.com and you can opt in for my book. It's free. But if we look at interest rates, statistical inflation, where commodities are, where the U.S. stock market is, where gold stocks are, they all fit the 1960s comparison really, really well. So this shows over the next, this is the Barron's Gold Mining Index, so this shows over the next 20 years what's the potential. Obviously, there's some sharp downturns in there, but we've only gotten started. So, I mean, the next 10, 20 years are going to be a great place to be for gold stocks. Okay, so to sum things up, the one big takeaway is, at least over the next couple months, or probably until the end of the year, U.S. stock market is going to rally, global stock markets are going to rally, and gold is going to correct. So the sharp move that gold has had since May, it's over. Gold's going to correct. Now the key levels, key support levels to watch and look at for gold, the first would be 1420 to 1425, but really in the big picture, 1400 and 1370, those are the keys for gold. And then for GDX, $25. And I mean, to sum it all up, if we continue to get rate cuts into next year, and we get aggressive rate cuts, then the trajectory over the next 12 to 18 months for precious metals remains really bullish. And just the last point I would make, given my outlook from now until the end of the year, with stock markets rallying, gold probably correcting, consolidating, I think that potentially is a better time to own like energy and base metals. They should perk up a little bit. So that's the end. Thank you so much. And with that, next up we have John Kaiser.